So I'll just
Okay.
quickly say, fools, we are delighted again to have Professor DeMater on, educate us on valuation. And this is, I think, the fourth class he has taught us in the past like 2 years. Some were just to our new analysts, and some have been to the whole team. In November of 2021, he did a 2-hour class, 1 hour, 55 minutes. It's up on his YouTube channel, of a step-by-step introduction to his simple free cash flow to the firm discounted cash flow model, up on his website at NYU. It is free to everyone. And we did a valuation of Tesla, step-by-step, how to do all the inputs. And it was fantastic. And now we're going to talk a little bit about using his free model to do a reverse DCF, where you were solving for one input to try to find out what is baked into today's stock price, what expectations are baked into today's stock price. And then we will probably also talk about some of the potential pitfalls of reverse DCFs. So with that, Professor, thank you, and I'll turn it over to you.
Hi, John. Thank you. Before I start, I thank you for joining. And I'm going to make a confession up front. If you expect me to spend the next hour in an Excel spreadsheet, I don't plan to do that. It's not my preferred habitat, first. Second, I'm not an Excel ninja. I've never been one. I know just enough Excel to get by. And third, I think it's damaging to your brain cells to hang out in an Excel spreadsheet too long. So what I'm going to do actually is start with an Excel spreadsheet, show you the minimalist tools, and the key word is minimalist, because I'm sure most of you are much better versed at Excel than I am, that I use in Excel, because to me, Excel is like a hammer. If you have a nail, you use it to hammer it in, but if you have a screw, don't use the damn hammer, because you're going to create more damage than anything else. And I'm actually going to start with a Tesla valuation. Why? Because, Tesla is one of those companies, no matter what you follow, it is fascinating. It's like watching either a car crash if you're negative, or the rebirth of the next great company. So as you well know, Tesla's had a bad few weeks, say months. Its stock price is now down to about 200, 210, 215, depending on the day. And last week, they came out with their most recent quarterly earnings. Kind of a mixed bag, right? Because it contained some good news on earnings, and it contained some bad news on growth, and some very difficult news that was not quite consistent in terms of capex and what they were doing. So I'm not quite ready to revalue Tesla yet. I plan to do it because the full quarterly reports are not yet out. What I'm using are the numbers from the earnings call that was made, where you get subsets of the financials. But I'm not going to take you through a full-fledged valuation of Tesla. I'm going to use it as a vehicle to ask what-if questions, and why we ask what-if questions, and what the problems are with reverse engineering from an Excel spreadsheet to what the price is today. So let me cut to the chase.
Professor,
I updated the numbers last week. Sorry, John.
I just want to quickly say, when you valued Tesla for us last time, November of 2021,
I valued at 571.
Yes,
which was before a 3-for-1 stock split. So I'm glad you brought that up, because it was 190 per share in today's terms, and the stock was trading, I think, at about $350, $400 per share. So the price, but first thing, never claim vindication when the market price moves in your favor. It's one of the most dangerous things you can do, because the market's almost setting you up when you do that, because you know what's coming, right? Right after you claim vindication, the market's going to say, okay, let me teach you a lesson. So to me, there's a lot of noise in here. So I'm not going to claim vindication. So I want to revalue Tesla a year later. Have things changed? God, have they changed? Not so much at Tesla, but in the rest of the world, right? November of 2021, the valuation, I used the risk-free rate then, which was like 1.5%, 1.7, I think. Equity risk premiums were close to historic lows, close to 4%. Nobody was talking about a recession. is a very different world. So it's kind of unfair to actually just change the numbers on one company and leave everything else alone. So I updated everything. First, I updated the numbers for Tesla, the new revenue numbers, the new operating income numbers, the new financial numbers. I did update the risk-free rate. Now, T-bond rate is now up to about 4%. In fact, that might get dated by the time we get through this session. Who knows what the T-bond rate will be? And because equity risk premiums and default spreads have gone up over the last year, and some of you might have read my posts on risk capital and how it's fled the market, the cost of capital I'm going to use for Tesla in my 2022 valuation is about 9%. That's a median cost of capital for a US company today. In US dollar terms, it was about 6% a year ago. The world has shifted under us, and I've got to shift with it. The bottom line, those with the updated numbers, the updated macro inputs, the value that I got per share, and I've actually shown you, I've copied that so you don't have to go back and forth between the worksheets, is $177. So my $190 has depleted somewhat. I think the improved margins have helped, but a lot of other things are working against Tesla. So I was actually surprised that my value dropped only $13, to be quite honest. I was expecting a much bigger drop because when you raise the cost of capital, you'd expect from 6 to 9%, that's a pretty hefty increase. You'd expect a much greater increase, but there are lots of inputs that have also shifted. But at $177, it is still lower than the stock price for the day I did it was $210. Now, whenever you value a company, you get a value different from the price. One of three things is going to be true, right? One is that you're right and the market is wrong, which if you have enough of an ego is always the position you take. The other is the market is right and you are wrong, which if you're tremendously insecure is always the position you go to. Or you say, we're both wrong. One of us has to be less wrong than the other. Please, God, let it be the market. I'm sorry, let it be me so that I can make money. So let's start by addressing why we ask what if questions. We ask what if questions because we feel uncertain about our inputs, which is good, right? We are uncertain about our inputs. Every single input I have in this valuation is an estimate, and I'm going to be wrong. And it's good to ask questions about how wrong can I be? But as I said, the market could be wrong as well. So one thing to ask as a simple follow-up question is, what has to be true about the company for the market price to be right? That's the basis of expectations investing, right? And a couple of pieces of advice, and I don't want to talk down to you because if you're much more advanced in Excel than I am, none of this is going to come as news to you. But if you want to ask what if questions with your spreadsheet, here are a few pieces of advice which you might already know. First, separate your input page from your output page. What I mean by that is, in your evaluation, you have lots of inputs, but you never want your inputs to be embedded in your output page. It's just a pure mechanical issue because that way, when you change numbers, they're happening just in your input page. Second, never hard code numbers into your spreadsheet. If you hard code numbers, asking what if questions is extraordinarily dangerous because the hard-coded numbers will never change. You know what I mean by hard-coded, right? You're in a hurry to do a spreadsheet. You want to change the margin in year 9 in your spreadsheet, but rather than changing it in your input page, you say it's going to be easy. Let me just change my year 9 margin. Then you forget you changed it, and then it's 6 months later. You're asking what if questions. Your year 9 margin stays frozen at what it was. Never hard-code numbers. Third, less is more. If you have a spreadsheet with 500 inputs, there's no point asking what if questions because you have no idea what happened in the first place in your base case. What's the point of asking what if questions? One of the reasons it's easy for me to ask what if questions with my spreadsheet is there are only, if you think about it, they look like there are lots of inputs. In fact, after I said less is more and I sent the spreadsheet out, people pushed back and said, but you have lots of inputs in your spreadsheet. Most of them are not inputs. It's just reference numbers that I pull off financials. So everything you see up in this section is really not an input. It's basically my base year numbers. I can't make up base year revenues. Never ask what if questions about the past. You know why, right? It's happened. You can't say, what if my earnings last year were 10% lower? That's fantasy. The what if questions always have to be about the future. And they're really only, if you look at this valuation, the inputs that drive this valuation are all between the cells, B22 through B30. That's it. Those are the inputs that drive the valuation. That's again something that when you build a spreadsheet, you should be aware of. Be clear about the numbers that are your input numbers and the numbers that are feed-in numbers that come off financial statements. Those are the 8 numbers. So I'll take you through my base case, what I'd assume for Tesla. I've assumed a 25% growth rate for the next 5 years and beyond. And to give you some perspective, that gives them revenues of about, I think, $420 billion. That's a big story. How big? Remember my Tesla presentation last year where I said have some perspective. Toyota has 300 billion revenues. I'm making Tesla the largest automobile company in the world over 10 years. I'm giving the margins of 20%. Again, perspective. A typical automobile company has a tough time breaking double-digit margins. Tesla seems to have figured out a way because it's some combination of technology and automobile that allows it to have higher margins. It's a one place where Tesla has I think, run ahead of where I expected to. His margins are much higher than what you'd expect at a typical manufacturing company. So I've used a 20% target margin. They're right now at about 18%. So I'm not overreaching here. I'm pretty much just pushing the margin up 2%. I'm assuming that convergence will happen by year 5. Convergence in the sense they're at 18% now, they can get to 20%. That gives me a pathway how quickly they can get there. Here, it's not a big deal. The difference is small enough that I could use 2 or 10. It's not going to make much of a difference. And to estimate reinvestment, I've used a sales to capital ratio for the next 5 years of $4 of revenues for every dollar of capital. If you remember, that measures the efficiency with which I generate my revenues. The higher that number, the more efficiently I'm generating revenues. Why am I giving Tesla higher efficiency in the first 5 years? Because they've just come off building new capacity in Germany and China. And I'm assuming that they can use that new capacity to cover some of their growth. But almost 2/3 of their growth for the next 5 years is covered because of the investments they've already made. It's excess capacity showing up. But after that, in fact, if you look at my numbers after that, it's just 2/3 of my initial number. And the reason I've made it linked to my initial input is when I change an input, I want other things to change as well. So I'm not changing 5 inputs. So if you think about my story, it's a story that's a big story of revenue growth of 25%, margins converging on 20%, sales to capital of 4, and my cost to capital is 9%, pretty close to the median company. Now, could I be wrong about those 4 inputs? Absolutely. Now, in reverse DCF, here's what you do. You ask, what must the market be thinking about an input for the value per share to be equal to $210? Pretty sensible question to ask, right? I mean, I love Mike Mabusson, and I mean, if you've read Expectations Investing, that was the essence of that book. Why don't we reframe the question? But be clear about what that question does for you. I've heard people say, well, if I do that, I don't have to estimate growth. That's not true though, right? Because if I reverse engineer and tell you what the growth rate has to be to get to $210 per share, you still have a judgment call to make. Is that growth rate too high or low? So there's no getting around making a base case estimate, but this might flesh out how much buffer do I have in my estimates to be wrong and still make a judgment. So here are the couple of very basic tools I use. First, before I get started, I go into I'm using the Mac version of Excel. So if you have the PC version, it might be slightly different. If you go into preferences in Excel and you go into calculation, one of the things that in every one of my spreadsheets, I always turn on is the iterative calculation. Why? Because there are inputs that actually become outputs. And if I'm not careful and I change something, it can cause. Now, I'll give you an example. One of the numbers I want to solve for is what is the market assuming about the cost of capital that will give me a $210? It's an IRR, right? Now, normally use the IRR function in Excel. Don't do that when you do valuation. And here's why. Your terminal value is a function of your discount rate. And in an IRR calculation, what happens is if you use the IRR function in Excel, it keeps your terminal value constant, which is not the right thing to do. So you have to set off the iterative function for this because you want to be able to change things which feed through into your valuation. So make sure if you're using my spreadsheet, at least that you have the iterative function. If you're using your own spreadsheet, that there are no circular components, and if there are, to set this off. So here's a very basic tool that I use. You can use either Solver or GoldSeek. Either one works for me. I'm going to use GoldSeek because I use that every month to solve for my implied equity risk premium. So when you open up GoldSeek, of course, you get a very simple box which says, what do you want to set as your output cell and which input do you want me to vary? It's basic, right? So let me start by going into my output cell and specifying what my output cell is. So basically, I'm picking the value per share and say, I want that to be my output cell. I want to set that to the market price, which is $210. Unfortunately, I've sent Excel this question. Why don't you let me set it as a cell? It doesn't let me, at least in the Mac version. I have to actually enter a number. So even though I have a cell there with the market price, I can't set it to that cell. I have to actually enter a number. And then it says, which cell do you want me to change? And now I have 5 choices. I can change the growth rate. I can change the margin. I can change the sales to capital ratio. I can change the cost to capital. Or I can go in and change something in the terminal value. That's one of the first things you got to ask is which input, because if you start asking questions about every input, you're going to end up with this page of if this input changes, this, and you're going to drown in what ifs. So in every evaluation, this becomes a question. What is my key input? What is the input I want to work? So before you start going down the cell sequentially, ask what is in my valuation of whatever company I'm valuing, what is it that I'm most uncertain about? To me, at this point in Tesla, it's a revenue growth question. It used to be margin, right? Because when they used to struggle with losing money, the question was, can they get to 10% or 12%? They're actually showing they can deliver the margin. The struggles they might be having will be on revenue growth. So let's make that the question is, I want to change my revenue growth number. You ready? This is going to be magical because when I hit OK, you're going to see the revenue growth number go, there's something crazy going on here, right? So let's go back. Tools, GoldSeek, valuation output. 210. Changing cell. Oh, sorry. What the heck is happening here? I didn't expect that. Let's see it. Okay, let's go back and look at the output because it's a good thing. I didn't expect this to happen. So maybe let's see what's going on with the valuation. Of course, everything's gone crazy. I am not getting the input cell working. So something is off. Let's try margins. Let's see if it's a system-wide problem or because I just checked this before I got on, it was working. I know exactly what's going on. Let me change this off. Let's try this now. Use GoldSeek. by changing cell. Okay, this one works. So I'll have to work out what's happening with revenue growth. So basically, I need a 23% margin to break even with the $210 per share. Now, I could do this with every single input. In fact, when I do it with the discount rate, there's actually a very interesting reading that you're going to get. I've used a 9% cost of capital. I can solve for that cost of capital that makes my value per share equal to $210. The question is, what do I do with this? I mean, you look at the 23% margin, my base case estimate was 20%, right? So one way to ask yourself the question is, could I be wrong by at least 3.09%? If the answer is yes, remember we talk about margin of safety? This is another way of reframing margin of safety, of saying, look, I'm uncertain about the margin. I use 20%. The market is using 23%. That difference is small enough that I'm going to view this company as fairly valued. If the difference is 8%, maybe say, there's no way I can get there. So one of the uses of reverse DCF is to stress test your assumptions. But notice that my goal seek or my solver allow me to make only one input, my uncertain input. You know why that is, right? Go back to high school. You have one equation. What's the most unknowns you can have? You can have only one unknown. That is the Achilles heel of reverse DCFs. Because you can solve for only one number at a time. What is the growth rate that will give me $210 per share? What is the margin that will give me? But implicitly, what you're assuming is your everything else will stay where it is. Let me ask you a question. Step back from the Excel spreadsheet and ask yourself a question. Is that realistic? May I ask, when companies have revenue growth, let's say it's a macro shock, a recession you're worried about. Revenue growth is going to be lower than expected, right? But what about margins? What happens to companies when you have a macro shock hit your revenues? Your margins also tend to be lower. One of the problems you have when you do reverse DCFs is because you're holding one input, varying one input and holding everything else constant, you get a very misleading view of what the real break-evens are because other inputs could change with them as well. If it's a macro shock, they will tend to move together. They're positively correlated. But there are times where you might be asking what if questions about an input where it's a different business model you're testing on. Let me give you an example. I mean, let's assume you're looking at Peloton. Peloton, as you know, is going through really tough times. Part of the reason it's going through really tough times is 3 years ago, pre-COVID, it was primarily an equipment company that sold subscriptions on the side. So it was a company that made money on the bikes and the treadmills they sold, and then had this premium subscription. And that was their model, right? And so when they went public in 2019, I described them as a niche company. Why? Because who can afford to pay, what, $50 a month for a subscription to Peloton? So I said, it's great if you're making lots of money to have Peloton, but this isn't mass market, exercise equipment. And during COVID, of course, they experimented with a lower cost subscription model, did really well for a while, which led them into delusional states about what they could do in the future. But right now, they're at the cusp of, do we stay with what we used to do, which is sell equipment with these subscriptions, or go entirely into a subscription model? You're saying, what's the benefit of going to a subscription model? Subscription model has two advantages over an equipment model. One is it's less capital intensive, right? You don't have to have manufacturing. So your sales to capital ratio presumably can be higher because you're not investing as much. The second is the subscription business is a much higher margin business. Why? The extra subscription you sell costs you almost nothing to sell. So it's almost all, it's like software. It's like pure profit. In contrast, the equipment business, you got to make the damn treadmill before you sell it, which means no matter how efficient you are, you're going to have lower margins. So I've seen people take Peloton and say, okay, let me push up the margin because they're going to be a subscription business. Okay, that's true. But it comes with a catch when you think about revenue growth. At least in the periods that you shift from equipment to subscriptions, your revenues are actually going to decrease because you're not going to get that oomph of a $2,500 treadmill or a $4,000 treadmill pushing up your revenues. What I'm trying to say is some cases when you do business models and you say what if questions on the margin, you got to complete the question by saying, what if I go to a business model that increases margins? And you have to think through what if the effects of that what if on, hey, that'll cause my revenue growth to be lower because it's a different business model. It'll change my sales to capital ratio, and you cannot do that with the reverse DCF. So reverse DCFs are great if you understand the limitations. The limitations are you can change one variable at a time, and then you can look for buffers and say, how wrong could I be? But you're missing the effects of those cross correlation across variables. So I'm going to kind of switch away from Excel spreadsheet because you can see the tools within Excel are pretty simple. You can use them to ask reverse DCF reverse DCF questions about any input that you want. Let's step back and say, how do I pick an input? When do I ask questions about macro inputs? You know what I mean by macro inputs, right? Right now, one of the questions we face is, what will the T-bond rate be 5 years from now? My advice is stay away from messing with macro inputs when you value individual companies. Why? Because when you change macro inputs, you're really asking questions about the entire market. If every one of your valuations becomes this, in navel gazing exercise, and in the S&P 500 fairly valued, you will never spend time on your company. So before I go to the spreadsheet, are there any questions specific to, how you frame what ifs in Excel before I, start talking about why we do this in the first place, what the other tools might be?
Professor, because so many of us use your model, what did you change to make the goal seeker work? You went in and you changed
There's
something from a
something
yes
which is
to a
going
no?
on, which is, see, with growth, one of the problems is because I've linked up things, it is entirely possible that one of my links is causing the whole, and that's one of the problems when you do goal seeks, is if you have elaborate connections between your inputs, sometimes one of the connections gets triggered. So clearly there's something wrong and I need to fix it. So, but I didn't even ask the question about the revenue growth, because until I fix that connection, you are going to get weird numbers. That's why I changed it to the margin. But the basic goal seek should work on any input if it's feeding into the numbers directly. There's something about my revenue growth where I think it is affecting future growth rates in strange ways. I've got to fix that connection. It's probably a quick fix, but I need to see the insides of what's going on.
Sure.
But usually asking the what if question works on revenue growth. In this case with Tesla, there's something I've done that's causing the numbers to kind of reverse engineer.
Sure.
Because I do a gradual decrease from that growth rate down to a stable growth rate. Maybe there's a leg there that I need to fix that didn't go right, but I'll make sure that gets fixed.
Perfect. Thank you.
So let's open up. Can you guys see my slide? Okay. So I'd like to talk about why we do what ifs, kind of step back and say, what is the point of these what ifs? Because let's face it, it's become far too easy to ask what if questions. Does that sound like an odd thing to say? I mean, but I think it's become much too easy to ask what if questions. And we've lost focus on why we ask what if questions in the first place. So let's start by looking at what it is that makes us uncomfortable when we value companies. It's uncertainty, right? If you felt certain about every input, which is a very dangerous place to be, you would never ask what if questions because you're so absolutely right, sure that you're right. This is what, I think freaks me out about some very stringent value investors, is they're so convinced that their inputs are right that they will never ask a what if question. In fact, asking a what if question they view is a lack of conviction, which is absurd in my view, because uncertainty is part of life. It's always been part of life, right? We act like we invented uncertainty. Every generation thinks, oh, we're in this unique period. Nobody's felt as uncertain as we do. Poor us. Hey, trust me. There have been far larger uncertainties in the past, going back to the start of man. In fact, for the bulk of humanity's stay on this planet, the uncertainties we faced were physical uncertainties. You know what I mean, right? The cave person who didn't want to deal with uncertainty starved to death in a cave. They didn't go out saying, I want to seek out. These were not bungee jumpers. They took risks because if they did not take risks, they would not eat. In fact, it's only in the Middle Ages that we started separating physical from financial uncertainty. So until you got to about 13 or 1400s, the people who took physical risk also got the big rewards. What happened in the 13 or 1400s? You had insurance start to show up for the first time. So you had ship owners in London buy ships. They never got on their own ships, but they put sailors on the ships and go to the Far East and get us some spices. If you get a chance, look at the mortality rates of sailors on those ships. It's mind-boggling. I mean, their ships sank because of storms. They got scurvy. People died. So you got a separation of financial from physical risk. So when I hear traders complaining about how risky it is today, I say, get down on your knees and thank the Lords that the risk today that you face is financial risk, and you don't have to run across 6 lanes of a highway to get to your brokerage house to trade, because that'll teach you the true meaning of risk. But today, when we're talking about financial risk, we act like this is something new, but risk has always been with us. So, and it makes us uncomfortable as human beings. Let's be real. I mean, this is not just in investing. It makes us uncomfortable to face any kind of uncertainty in life. Not knowing how many people are going to be at Thanksgiving drives my wife crazy. She says, will we have 10 or will we have 8? Because she has to plan for it. Uncertainty is a fact of life, but it makes us uncomfortable. And when something makes us uncomfortable as human beings, guess what we do? We have very unhealthy responses. So let's look at some of the ways we deal with uncertainty, which are not healthy. The first is we go into denial. So what uncertainty? I don't see it. We act like we cover our eyes, there's no uncertainty. And then we get paralyzed. How often do you see people say, I cannot value a young company? What's the reason they give for not valuing a young company? There's too much uncertainty. When I say some people, I'm including most VCs in this group. Their excuse for not actually valuing companies and instead pricing them based on number of users, number of downloads, is because they say there's too much uncertainty. So the first reaction on uncertainty is we shut down. I can't deal with this. I'm not doing. You know how many people stop valuing companies in the middle of a crisis? They just said, look, I can't do it. There's too much uncertainty. They did it in 2008. I see them doing it now, saying there's too much uncertainty. And what do they tell you? Let's wait for the uncertainty to pass. And then we'll get back to valuing companies, by which time it's way too late. The second is what in behavioral finance are called mental shortcuts. You know what mental shortcuts are? We use a rule of thumb. Anytime you use a rule of thumb, you are using a mental shortcut. Why are you doing it? Because you feel uncertain. You think the shortcut will work. I know people who hard code revenue growth rates into an Excel spreadsheet. And every young company, they put it in that spreadsheet. Why? Because that worked in company 1 that I valued 50 years ago. I'm going to stay with that no matter what. The third is actually a very natural reaction. When you're not sure what to do, you drive to a mall where there are 7 restaurants, you haven't done your research, you don't have Yelp on your phone, you don't know which restaurant to pick. Guess what you do? You look for the restaurant where the most people in it and say, well, that must mean that restaurant is a good restaurant. Most of the time, that's not a bad strategy, right? In fact, when you use Yelp reviews to pick restaurants, you are joining the crowd because you don't know. I don't know how to measure the quality of a Thai restaurant. Hurting. in investing. That's common, right? When you don't know what the value of a company is, you wait to see what other people are doing. And let's face it, with young companies, herding is the primary instinct, which is one reason you get these wild swings. I mean, take a look at Peloton, which has dropped 90% from where it was at its peak, and say, what changed? There wasn't a huge amount of fundamentals that shifted, but the momentum has changed. The crowd is moving in the other direction. The fourth reaction to uncertainty is you say, I don't know how to deal with this, so let me ask somebody. Thank God for this, because without it, macroeconomists would not have jobs, right? Why do they exist? Because I don't know what interest rates will do. Let me ask this expert, as if the expert has any idea. You know what the forecasting accuracy of macroeconomists is? They exist to make soothsayers look good. It's absolutely abysmal. But why do we use them? Because it allows us to use the excuse of, I asked our economist, he said interest rates are going to go down, so I used that in my valuation. It's natural. And then there's that fifth fallback when you feel uncertain. And this is as old as time. You don't know what growth rate to use for your company. You've done everything you can. So finally you get down on your knees and say, please God, give me Tesla's growth rate. I don't know about you. I never get any revelations when I ask for that insight. But divine intervention is your ultimate risk management tool, right? The problem with uncertainty is not that it exists. It exists. It's a way we deal with it. So I'm going to make some suggestions on uncertainty in valuation. Perhaps this can help in framing your reverse DCF. When you value a company, you face uncertainty on every conceivable front, right? In fact, every single one of your inputs is an estimate. Let's be quite clear about it. Even the numbers that you took as facts for last year are estimates, right? They're estimates because there were accounting choices that were made about how to book revenues. Everything's an estimate. Here's my suggestion to you. When you sit down to value a company, make a list of everything you're uncertain about. It'll be miles long, but it's cathartic. I'm uncertain about this. I'm uncertain about that. I'm uncertain about this as well. And then start putting those uncertainties into buckets. Here's the first bucket. Is it estimation uncertainty or economic uncertainty? You're saying, what's the difference? Estimation uncertainty is uncertainty you can reduce by doing more homework, collecting more data, doing more research. So if you don't know what the margins are in a sector, you can go collect the margins of other companies, look at the average. That's estimation uncertainty. So by doing more homework, you can reduce estimation uncertainty. Economic uncertainty is uncertainty you can do nothing about. All the research in the world will not put a dent in economic uncertainty. And I have some really bad news for you. In some companies, most of the uncertainty you face is economic uncertainty. It's not estimation uncertainty. You know what that means, right? Often when you value a company and you feel uncertain, what's your urge? Let me go do more homework, collect more data, do more research. If the problem is estimation uncertainty, your valuations will get more precise. But if your problem is economic uncertainty, you're just embarking on a path that's going to cost you a lot of time and do absolutely nothing for you. I mean, think about it. Whether Tesla can get to 400 billion in revenues will end up at 200 to 600. You know what the big factor driving it is going to be? What percentage of people globally are going to shift from gas to electric, with this wild card of what if you have hydrogen cars? Who knows what other technologies? That is really the big macro uncertainty, right? No amount of research you do is going to make that uncertainty go away. There's a point in valuation you've got to take the karmic view, which is there are some uncertainties that I can do nothing about. They're going to flow through into my valuation. They're going to make my value range, estimation versus economic uncertainty. Any questions on estimation versus economics? So think about the uncertainties you face in the last company you value. No. The second grouping of uncertainties I'm going to break into micro versus macro uncertainty. Micro uncertainty is uncertain you feel about your company, the management, its business model. Macro uncertainty is uncertain you feel about interest rates, about inflation, about GDP growth, about the Fed. Be honest with me. On your last valuation, how much of your time did you spend worrying about macro stuff? I mean, we live in a world where this year in particular, it's inflation. I mean, everything is being driven by macro stuff, right? You can see why people are not paying attention to companies because the macro stuff is dominating our thinking. And here's why we make that distinction. Micro uncertainties show up in your expected cash flows. They're the numerator. Macro uncertainties mostly show up in your discount rate. If you're a diversified investor, diversified in the sense if you have 20, 30, 40 stocks in your portfolio, which any sensible investor should have. I mean, don't give me this crap about concentration being better for you because it shows conviction. It's one of the most absurd arguments that I've heard because it suggests that somehow you can make micro uncertainties go away. So even if you're a value investor, pick 20 value stocks rather than 5 value stocks. Because what does it do? It makes the law of large numbers work in your favor. What's the essence of micro uncertainties? Uncertainty specific to your company, right? Your management could do better than expected or worse than expected. Your business model could perform better than expected or worse than expected. And because it's specific to your company, it can cut in different directions for different companies. When you diversify, and you hold 20, 25, 30 companies, micro uncertainty should average out. As for macro uncertainties, hey, if inflation goes to 10%, I don't care whether you have 5,000 stocks in your portfolio, 50, you're going to feel the pain, which is one reason we say if macro uncertainties are dominating, my discount, and that's why if you think about it, the cost of capital this year has gone from 6 to 9%. Macro uncertainties are making us terrified, and the place to show them primarily is in the discount rate. I'm not saying inflation doesn't affect your micro variables. It could show up as pricing power and margins, but it's micro versus macro. And you can see how that can shift from year to year. In good times, we tend to ignore the macro stuff. Now we're in time, we worry about the macro stuff, we forget about the micro stuff. And there's a third grouping of uncertainty that I would like to bring to the forefront. Some uncertainties are continuous. You have a US company with European operations. Every time exchange rates change, and think of how much exchange rates have changed this year, your cash flows are changing, right? Because the exchange rate is changing on a minute-by-minute basis. So some uncertainties in valuation are continuous. And we're very good in finance at dealing with in fact, that's the only kind of risk we actually bring into risk and return models. But there's uncertainty that I call discrete uncertainty. It doesn't happen very often, thank God, but when it does happen, it is catastrophic. We're terrible at dealing with discrete uncertainties. I'll give you examples of discrete uncertainties. You're investing in Bed Bath and Beyond. God only knows what story you'd need to tell me to justify it. I mean, there's continuous uncertainty, right? How many people will come into this crappy store that carries, I don't know what anymore? That's a continuous uncertainty. What will growth and margins do? But there's a discrete uncertainty hanging over your head, which is, hey, what if the company doesn't make it? That's discrete uncertainty, and there's no way to bring it into a traditional DCF through discount rates or cash flows. You know, that's the other thing you worry about in periods like this one, when macro uncertainties become much larger, is you worry about failure risk. Remember those rumors floating around a few weeks ago that Credit Suisse wouldn't make it? I mean, there were rumors, but if you're valuing Credit Suisse, and I plant this thought in your head, it is going to affect your valuation. It should. The first place to go when you deal with uncertainties is don't treat them all as equivalent. Start putting them into buckets because they will tell you what to do about those uncertainties. So I'm going to introduce a structure to introduce some reality checks when you do uncertainty. As some of you know, I like this corporate life cycle structure to think about companies. You tell me what company you're valuing, I can kind of tell you what kinds of uncertainties you're going to face and how much uncertainty you're going to face. So in this life cycle, you can see your startup is like a baby, young companies, middle-aged companies, old companies, dying companies. You tell me where you're in the life cycle, I'll tell you how much uncertainty you face. And the reality is you face the most uncertainty at both ends of the life cycle with very young companies. Why? Because you don't have a business model, you don't know what the market will look like. To declining companies because you feel uncertainty about, will this company make it? What's happening in the business. The least uncertainty is in the middle. Now, do you see why old-time value investing leads you to mature companies? Because if you start with the premise of uncertainty is bad, I want to avoid it, you are going to be stuck in the Kraft Heinz's and the Coca-Colas of the world in perpetuity. Nothing wrong with that, but at least be honest with yourself about why it's happening. You make avoiding uncertainty number one on your list, which unfortunately is much as I love Ben Graham's ideas, he was a fixed income guy at heart in terms of how he thought about stocks, right? His view was, I want a bond with price appreciation when I get a stock. That's why you have to focus on dividends as cash flows and protecting your price. Nothing wrong with it, but at least be honest with where it'll lead you. It'll lead you to the middle of the life cycle. There's no way Bed Bath & Beyond is going to make it into your portfolio, even if it's massively mispriced or underpriced, if you follow the Ben Graham rule book, and there's no way Tesla will make it into your portfolio either. The types of uncertainty also change. Early on, you're going to face mostly economic uncertainty. Why? Because you know what estimation uncertainty, there's nothing there to estimate for your company. It's all about what will the market look like, what will the total addressable market be, what will their market share be. There'll be a lot of micro uncertainty, right? Because your company has to be managed, right? It's got to build a business model. And a lot of discrete uncertainty. 2/3 of startups don't make it through year two. A lot of failure risk. A lot of I've run out of cash risk. A lot of founder-related risk. So one of the things to think about is the kinds of uncertainties you're going to face are going to be different depending on the company you're valuing. So when you pick up a company, before you even start in the Excel spreadsheet, think about, hey, where in this company am I going to feel most uncertain? What types of uncertainties am I going to face? Now, as you see in my spreadsheet, it's built around 6 inputs. That's basically what gives me the power to ask what-if questions. 3 of the inputs cover my business model, revenue growth, margins, sales to capital cover my cash flows. My cost of equity and cost of debt show up in my cost of capital. So in fact, you can consolidate those into one input. And then I bring this discrete risk into a failure risk input. Why? Because you cannot bring discrete risk easily into discount rates. If you don't know whether your company will make it through the next 6 months, how the heck can you make your discount rate high enough to capture that risk? It's impossible to do. Discount rates were never designed to capture discrete risks. So when you look at, and I'm very quickly going to hit you 3 valuations across the life cycle, you can see the kinds of things I worry about with each company are different. So the first company I'm going to show you a picture of is a company called Zomato. Those of you not familiar with Zomato, it's an online, it's a food delivery. It's an online food delivery app in India. The company went public about a year ago, and I valued at the time of its IPO. Tremendous amount of uncertainty in the valuation because it actually has about a 40% market share of the Indian food delivery market, but the Indian food delivery market is about 1/10 the size of the US food delivery market and about 1/25 the size of the Chinese food delivery market. So the uncertainty here is not so much about Zomato, but about how food delivery in India will evolve over time. This is going to be a function of Indian food. I mean, think about the questions they're asking. It's not about what will the margins be next year. Is, hey, will Indians actually order more food from restaurants or less food from restaurants going forward? Will the cultural habits on food change over time? But the bottom line was, when I valued this company, almost everything I was looking at was micro related in the question. I'm sorry, was estimation, was risk about what the market will do and whether the management of the company would be able to pull it off. So the reverse DCF that I did here was about revenue growth, because without the revenues, nothing else works. Will the market be big enough to sustain? Because I valued the company at the time of its public offering at about 41 rupees. The actual offering price was set at 75. And the day of the offering, it jumped to 125. And about 8 weeks later, it was trading at 150 rupees per share. It was trading at more than 3 times my value. Right? So I have a value of 42. And I thought I was being pretty optimistic about the story I was telling, where I was making my revenues grow 8-fold. Well, what would have to be true for it to be worth 150 rupees? And the answer was, well, the Indian food delivery market is to get as big as the Chinese food delivery market in 10 years. That's really the bottom line, because that wouldn't have to happen for the 150 rupees. And I said, there's no way that's happening, because Indians are not prosperous enough to be able to do it. Because the reality is not just your habits that have to change, you have to have the money to order from a restaurant. And the reality is 80% of Indians don't have the discretionary income to pick up a phone and say, get me my food from a restaurant. They're not in that position. So this is really as much a bet on how India will evolve and Indians' eating habits will evolve as it is a bet on the company. And my what if questions were framed around that basic uncertainty. What I'm trying to say is, when you do these reverse DCFs, don't just pick one input and make it always the input you change, because it's got to revolve around, in this company, what is it that I'm most uncertain about? In the case of Zomato, I'm most uncertain about the size of the potential market. And that's really the input that I built my reverse DCF around. Now, the second company I'm going to value is, I think it was Unilever. It says Amazon, the story, but it's actually a valuation of Unilever. Unilever, as you know, is a 100-year-old company, 120-year-old company. Hoary and very, very long tradition. But for the last decade, it's been stuck in terms of revenue growth being close to zero. Their margins they're pretty solid margins, but they're kind of stagnant. It's a company kind of clearly, not even middle age, but approaching old age. And you know what companies approaching old age try to do, right? They try to be young again. How do they try to be young again? They try to do acquisitions. Unilever has done a few acquisitions. You probably heard of the Ben & Jerry, but they bought Best Foods for billions of dollars. Nothing's worked, which is not surprising, because facelifts work for about, 6 months, and then they fall apart again. And these are all facelifts. That's what it is. In fact, in the last 4 years, they've been on this, and I don't want to get off on ESG, because I say terrible things about ESG, and I don't regret them. But for the last 3 or 4 years, Unilever has also been this big ESG, has shifted to ESG. And again, this should be exhibit 1 on why just using the words ESG or becoming an ESG company is not going to magically transform you as a company. No. So I think one of Unilever's products is Hellmann's mayonnaise. So they've built this, how Hellmann's mayonnaise is made out of goodness. They have this ad. In fact, as you watch it, you get more cynical about ESG. It's very difficult to frame mayonnaise as the savior of mankind and how it's going to make, hunger go away. But so for the last 3 or 4 years, they played that game. But the reality is the games have kind of run out. They've gone through 3 CEOs in the last 4 years. Clearly, they're waking up to the recognition that the best they can hope for is limping along. And my story reflects it. Low revenue growth, about 2%. And that's actually higher than their historic 10-year growth rate. I'm assuming that their margins will stay pretty stagnant, because there's nothing here to expect magical changes here. The value that I got was about 24 euros per share, and the stock was trading at about 45.60. Now, the big question here is, what can they do to make their value higher? And the answer is, their revenue growth is not going to jump to 10%. It's almost inconceivable that they can do that. There is talk that, and as you know, they've been targeted by I don't know which activist investor target, but they've been targeted by an activist investor. I mean, it's the same guy who actually targeted a food company in the US. It'll come to me soon. But he's targeted them for the same kind of action. He says, look, you've got to focus on, they have this hundreds and hundreds of brands. He wants them to reduce their brands to the most profitable. In other words, his story is, hey, maybe we can find a way to push up margins by being more focused. I said, okay, it's a reasonable story. The what if question that I asked in the case of Unilever was not about revenue growth, because revenue growth is not going to go from 2 to 10%. It said, what would the margins need to be to justify 45 euros per share? And it turns out margins have to be about 24 to 25%. So in fact, I went and looked at the activist plans. I'm not convinced that cutting out a few brands and focusing is going to improve margins from 18 to 24%. But at least we now have an open door saying, what are the activists planning? Is it something that can make enough of a change to justify 45 euros per share? I don't think so. But that's why we asked the what if question. But the focus shifted here because different. And the third company I valued was Bed Bath & Beyond. Now, of course, Bed Bath & Beyond is also in this small group of companies which share the grouping of meme stocks. I'll be quite honest, I don't understand memeing. I don't understand why you have to misspell the word hold for a decade, make it a secret code. No, I mean, it suggests some very strange, reasoning going on behind. But Bed Bath & Beyond, one of the interesting things about the meme stocks, this is as a tangent, is notice that they're all companies with names that if you're 35 years old, you recognize from your mall rat days. GameStop, Bed Bath & Beyond. It might not be coincidence, but maybe there's some weird emotional connection you have to what were the stores I used to see in the mall. I'm going to make them live forever, right? But Bed Bath & Beyond has, gone through some ups and downs. But the bottom line is there is no upbeat story I can tell about Bed Bath & Beyond. This company is beyond redemption in terms of storytelling. It had its glory days, and those glory days faded, and there's no way back. I don't care who you appoint as CEO, that's not going to change. My story reflects it. Notice that my revenue growth is negative. And this is my upbeat story for Bed Bath & Beyond. My upbeat story, here's what's going to happen. They're going to shut down their least profitable stores and the stores that suck up the most capital. So you're going to shut down that store you have in the middle of a city where you're paying huge lease commitments because it's just not going to carry. There's no way a Bed Bath & Beyond can deliver enough operating income to keep a Manhattan Bed Bath & Beyond afloat. So they're going to, and this is going to be a continue. They've already shut down, I think, 200 stores. I'm assuming a continuation of the shutdowns. I'm assuming that a sensible person is running the company, which might be a bad assumption in the case of Bed Bath & Beyond, because it's been a company run almost on nostalgia now for a while. But you're going to shut down these stores. And in my upbeat story, you're going to end up with a smaller Bed Bath & Beyond with stores in places where people actually like that concept. There are actually parts of the country where people like to walk into a store that supposedly sells home goods and walk out with 50 items that have nothing to do with your home. But that's a Bed Bath & Beyond concept, is you buy all this impulse stuff. I didn't need that. I didn't need that. When you come out and say, I went in to get some sheets and now I've come with 15 things that have nothing to do with sheets. In my upbeat story, there's the end game. We have a smaller store. In fact, if you look at my revenues, I'm assuming about a 20% shrinkage in revenues over the next decade. And in real terms, that's a much larger number. And I am assuming that margins improve, but they improve to industry averages. Just to give you some perspective, Bed Bath & Beyond in its glory days used to have margins of about 12, 13, 14%. That crap you bought at Bed Bath & Beyond, huge margin stuff. That gadget that you bought on the way out of the store, remember they used to have this section of gadgets right as you were waiting for the cashier? So I don't need that, but I'll get it anyway. Huge margin business. They're not going back to those margins, at least in my story. And is there a chance they can fail? I mean, they're already what, B, they're rated B, double B, somewhere over there. And based on the rating, there's actually a very real chance it can, in fact, there's about a 20, the reason it's so precise is just to use the failure rate associated with the rating, because I have these 10-year estimates of how many, what percent of the bonds in each ratings class fail. And the ratings class they're in, 23.74% fail. So I'm trying to be realistic and optimistic at the same time, and the two are not in conflict with each other. The value that I got was about $3.23. Stock was trading at $8.79. Could it be worth $8.79? I guess so. The question is, what do you want to ask what if questions on? There's really no point asking what if questions on the cost of capital. It's not like I'm giving them a huge cost of capital. Maybe margins. I don't know. No, I was not even tempted to ask what if questions, to be quite honest, because I looked at the 323 and said, hey, I want this stock no matter what the market thinks. But you can already see that the kinds of what ifs you ask vary depending on where your company is in the life cycle. I know we're running over time, so I'm sorry for taking up more of your time. But right now, though, the big what ifs you worry about are macro what ifs, right? What will happen to interest rates? What will happen to inflation? What will happen to exchange rates? What will happen to risk premiums? And macro variables show up both in your cash flows, because you are assuming, so if you think there's going to be a recession, it's going to be severe, and you're valuing a retail company, it is going to show up in your revenues and margins, not just next year, but because remember, severe recessions leave long-term damage. So it's not just you have a bad year and then you bounce back to where you were. No. So it is going to play into your valuations. So when you think about macro parts, as I said, the primary tool you have to change macro views is through discount rates. They show up through what you think about inflation will have to show up in your risk-free rate. And what you think about uncertainty in the future, what the economy will do, will have to show up in risk premiums. So that risk-free rate and risk premium, where you were a price taker when you did the original valuation. What I mean by a price taker is I use today's T-bond rate. I use today's equity risk premium in valuing the companies. If you want to ask what if questions, you might be asking them of those numbers. But remember, when you ask questions about risk-free rates and risk premiums, you're really asking questions about the overall market. Is the market overall, you're playing the role of asset allocator, which is a dangerous role to play because you're a security analyst, right? I wanted you to tell me whether I should buy Unilever or Bed Bath & Beyond. So remember, this role is a foreign one. You're doing it simply because you feel really uncomfortable. So when I do this, I almost never do this to say, will it change my investment? Because when macro variables change my investment in a company, it's because I'm changing my decision on whether to invest in equities in the first place. It's really doing it to make myself less uncomfortable. So just give you a sense of why 2022 has been so unsettling for us. This graph shouldn't come as something that should surprise you. You've been tracking the market. These are US Treasury rates this year. Across, starting with 3-month to 10-year. Has it been a year of change? And this was through September 23rd when I did a blog post on this. And you can see every part of the yield curve has changed. 3-month to 30-year, rates have gone up. But rates have gone up far more at the short end of the spectrum than at the long end of the spectrum. So no surprise, the yield curve has also shifted over the course of the year. Macro uncertainty is showing up in this case because it's inflation uncertainty is going to show up as massive changes in interest rates. Your base is changing in your valuation. You take the same company that you valued at the start of this year and you change nothing about the company and you change just the risk-free rate, you're going to get a very different valuation today than you did at the start of the year. But here's why it's become even more problematic this year. While the risk-free rate has gone up, primarily because inflation has gone up, risk premiums have gone up. You see this graph to the right, that's my equity risk premium for the S&P 500 by month into 2022. At the start of 2022, the equity risk premium I computed for the S&P 500 was 4.2%. On September 23rd of 2022, that number was close to 6%. Now, risk premiums clearly have gone up. You're saying, hasn't this happened before? Yes, it happened in the first quarter of 2020. It happened in 2008. But you know what's different about 2022? 2008 and 2020 had full-fledged crises, right? Equity risk premiums went up. But what happened to risk-free rates during the same period? First quarter 2022, the T-bond rate went from 1.7 to 0.7%. In 2008, the T-bond rate went from 4%. So what you had were risk premiums climbing, but risk-free rates dropping, which means that your cost of equity and capital were not changing that much. This year, we've had a double whammy. In fact, I've never seen costs of capital change this much in a year, in the years that I've been tracking cost of capital over the course of a year. Why? Because you've had more than a doubling of the risk-free rate. Went from 1.51% at the start of this year to 4% now. And you've had equity risk premiums go up. I am amazed that stocks have held up as well as they have, to be quite honest. Because this is a massive shock to the system. And of course, it is going to show up in, when you have macro shocks, they're going to show up in earnings and cash flows. And if you have a commodity company or a cyclical company, it's going to be a very, very real danger to your company's earnings when you worry about the macro environment. So here's my suggestion on macro variables. You're never going to be right. Asking an expert what they will be is useless. So when people give you views on inflation, it's their views on inflation. Let's face it, if I average all these views, maybe I'll get to the consensus. Because let's face it, if everybody thought inflation was going to go up and interest rates are going to be higher, they're going to be higher today. The very definition of consensus is where we are now. Right now, what the market has as a consensus on inflation is that inflation is going to come back down, but it's not going to go back to the 1.5% it was in the last decade. It's going to come back down to about 3 to 4%. That's what the T-bond rate is telling me. So if you build in different expectations of inflation than the market is, be very clear that you're deviating from the consensus, but be consistent within your valuation. You know what I mean by that? If you expect inflation to drop, but to stay at 6 or 7%, which would be 1970s levels, first, what should you be using as a T-bond rate in your valuation? If you've decided that 6 to 7% is going to be steady state in inflation, your T-bond rate has to be maybe 6 to 7% plus 1% more. You cannot use a 4% T-bond rate and build in 6% inflation into your cash flows because you're going to overvalue companies. So when you expect inflation to be higher, it'll show up as a higher T-bond rate. It'll change your growth rates. Even a low growth company will now get this oomph from inflation in steady state. When you get a terminal value, for God's sakes, don't use the 1.5 to 2% you've been using for the last decade while changing your T-bond rate to 7% because you're now building a valuation that's at war with itself. Be macro consistent. So if you want to take a view on macro variables, inflation, interest rates, the economy, be my guest. But within your valuation, be consistent. And since we're talking about inflation as the key macro variable this time, remember it shows up everywhere in your valuation. So if you think inflation is going to be higher, it's going to show up as a higher risk-free rate. It's going to show up as a higher risk premium. Let me explain why. Historically, higher inflation has gone with more uncertainty about inflation. It's a given. When inflation is 5 or 6%, there's more volatility in inflation, which feeds into higher risk premiums. Higher inflation is going to mean higher risk-free rates and higher risk premiums. And higher inflation is going to also show up in your growth rate. And how it will show up will depend on how much pricing power your company has. So if your company has solid pricing power, you might say, if I have 6% inflation, I'm going to feed it through into my valuation at 6%. But if your company doesn't have pricing power, it could be one of those companies that gets squeezed, like airlines. When inflation is 6 or 8%, their cash flows don't grow at 6 to 8% because their costs grow at that rate, but they can't pass it through in prices. So if you're going to assume a higher inflation, don't just pick a number and change it, it's going to change your entire valuation. And be very clear about where you're deviating from the consensus. So my suggestion is actually when you do your initial valuation of your company, keep the macro variables at the consensus level. So I value companies, I use today's T-bond rate. I use the 3% inflation rate. Even if I don't agree with it, I stay with the 3% inflation rate. I build in, if I'm valuing an oil company, I build in oil prices that are spot prices and forward prices today. I've finished my valuation. I make that my base case valuation. And then I go crazy with my macro inputs. And I'm going to get a very different value for my company. And so let's say I value Royal Dutch at $30 per share with existing oil prices and at $75 per share because I expect oil prices to double over the next decade. I'm going to be very careful about putting a buy recommendation on Royal Dutch, right? Because why did I find Royal Dutch to be undervalued? Because I think oil prices will double over the next decade. And if I'm that good at forecasting oil prices, what the heck am I doing? Wasting my time valuing Royal Dutch, right? I should be buying oil price futures. If you're really good at macro variables, what the heck are you doing at Motley Fool? Valuing individual companies. So it's actually good to separate macro. If you feel strongly about macro variables, and lots of people feel strongly about inflation, either in benign or malignant terms, my suggestion is do your base case valuation with a consensus estimate. As I said, the consensus right now in the market, and the market can change its mind, is about 3% inflation. That's where we're heading towards. After all this Fed tightening, loosening, pivoting, not pivoting, God only knows what. Do your base case valuation with that, and then ask what-if questions framed around what your macro views are. So any questions on macro views and asking what-if questions? Because in that Excel spreadsheet, I can solve for the risk-free rate, right? Give me the T-bond rate that will make my value 200. It's kind of a silly question. Because what exactly do I do with that, right? I can't say today's T-bond rate has to be replaced with this hypothetical T-bond rate. So with macro variables, I'm less inclined to ask what-if questions or reverse DCF around macro variables, because macro variables contaminate or affect everything. I can't solve for an inflation rate because inflation is in my growth, it's in my risk-free rates, it's in my risk premiums. How do you separate out those effects? So let me close with a few tools on dealing with risk. One, of course, traditional valuation. The way you deal with risk is you put it all into the discount rate. That's traditional DCF, right? When we do that, though, we're acting like we never took a statistics class in our lives, because there are probabilistic tools we should be using in valuation. One, of course, is what we just did, ask what-if questions. Reverse DCF is just a variant on asking what-if questions. What if growth is higher, growth is lower, margins are higher, margins are lower? So that's sensitivity analysis. The second is scenario analysis. What's the difference between sensitivity and scenario analysis? Scenario analysis, you construct full scenarios. Scenario 1, economy is in a recession. Scenario 2, economy stays where it is. Scenario 3, it's booming, and you value the company. And within each scenario, you'll have to have a fully thought through set of this is what the inputs will look like under each scenario. We'll talk about when scenario analysis works better than sensitivity analysis. The third is decision trees. Have you ever seen decision trees? This is, attach probabilities to each branch, and then you estimate what the next branches are. If you have a company where you have sequential risk, decision trees are a great tool to use. Say, why not have a value company like that? Say you're valuing a young pharma company. It's got a drug working its way through the pipeline, the FDA pipeline. You know where the sequential risk happens, right? You got to get through stage 1, then to stage 2, then stage 3, and then, then 3 more stages after that. Sequential because you can't jump the line and go to production without going through the first 3 stages. Then you attach probabilities to each one, and then you get an expected value to that. Not useful in a lot of companies, but in subsets of companies. If you have a company waiting for regulatory approval, you don't know whether it'll get it. Rather than try to bring it all into one valuation, you try to build decision trees and say, hey, this is the probability that the approval will be granted. And of course, there's simulations. You saw a variant of that when I looked at, I think, last time we talked about how you can take each of those inputs that you saw in my DCF and make it a distribution, which is really what you have in your mind, right? So when I ask you what's the revenue growth rate, I asked you to give me a point estimate for Tesla, but your mind was screaming, but I could be wrong, I could be wrong. What if I let you tell me how wrong you could be? That's what a distribution is, and say, you know what, I think the expected value is 25%, but here's the distribution of revenue growth rates, of margins. And the nice thing about simulations is you can correlate the variables, and you say, if revenue growth is higher than expected, margins are also going to be higher than expected. It's the most flexible way of dealing with risk. So let's start with the traditional way of dealing with risk and bring it all into your expected value. And there are two ways you can do it, right? One is to do it the way you're taught in discounted cash flow valuation, which is just your discount rate for risk. The expected cash flows are the expected cash flows. Don't ever adjust expected cash flows risk if you're doing a traditional DCF. They're your expectations. But there's another approach which you almost never see used explicitly in valuation, which is called the certainty equivalent approach. You know what you do in the certainty equivalent approach? You take your expected cash flows each year and you replace them with a cash flow you'd expect as a guaranteed cash flow. Have you ever watched Howie Mandel's game show, Let's Make a Deal? It's kind of a stupid show. But in the show, here's how, if you've never seen the show, you'll have these two suitcases up on the stage, right? One has $1 million, the other has nothing. And you're the contestant. You come up to Howie and he says, I'm willing to offer you a deal. And you know how the deal works, right? I'll give you $300,000 if you're willing to walk away from this offer that I made you. Remember, there are two boxes, right? One has $1 million, one has 0. On a pure expected value basis, what's the expected value of it should be 500,000, right? But if you're risk averse, which we all are, you'd accept less than 500,000 to walk away. The question is of how risk averse you are will show up in how much less you're willing to accept. So if you're not that risk averse, you might say, I want at least 400,000. But if you're very risk averse, you might want 300,000. Think, what's this got to do with valuation? Let's say I took your last valuation. You have expected cash flows every year for the next 10 years, right? Those are expected cash flows. Those are like those suitcases up on the stage where you don't know an exact number, but you've taken expectation across them. And then I asked you on each of these cash flows, how much would you accept as a guaranteed cash flow instead? So your expected cash flow next year in your company is $2 per share. I said, would you accept $1.50, $1.70? And if it's a very risky company, you might say, I'll settle for $1.25. I feel so uncertain about this number. In a certainty equivalent valuation, that's what you do, is you take every one of your expected cash flows and replace them with a certainty equivalent. You think, how the heck am I going to come up with the exact number? In fact, by going through exactly the same models that you use to adjust discount rates, I can give you a way of replacing expected cash flows with certainty equivalents. So it's not like you're doing something magical, but you're shifting your risk adjusting from the denominator to the numerator. Once you got those certainty equivalent cash flows, guess what you discount them back at? At the risk-free rate. So you discount them back at 4%. For the longest time, and I used to teach valuation, I don't hear as much of it anymore. And I talked about traditional DCF, people would say, but now I've been reading Warren Buffett and listening to him, and he said he uses the risk-free rate. At some point in time, somewhere, Warren Buffett has said to, I could never find a clip of it, but supposedly he said that he doesn't, he did it in the context, somebody probably asked him about the CAPM, and that triggers him, right? He doesn't like betas, he doesn't like the CAPM, and then he goes overboard often when he says, well, I don't use betas, I just use the risk-free rate to discount cash flows. So somebody in the class would say, if Warren Buffett uses the risk-free rate to discount cash flows, why shouldn't we use the risk-free rate to discount cash flows when you do discounted cash flow valuation? I said, okay, let's stay with the Warren Buffett model. When he looks at a company, what kind of cash flows does he discount? And the reality is Warren Buffett's tradition on cash flows is to focus on that which is predictable, investments already in place. If you took earnings, he's focusing on just the predictable component of earnings. In other words, he uses the word speculative, but that's one reason why he's never invested in technology companies. A lot of the earnings, he says, are speculative. They're uncertain. So I'm going to focus. So if you look at a company with a strong brand name like Coca-Cola, his view is, hey, that cash flow is going to be there. You know what implicitly he's doing, right? He's implicitly focusing on just that portion of earnings that is predictable. Think of it as a certainty equivalent earnings and discounting them. People do this all the time. In fact, people mix up the two approaches, the certainty equivalent. How often have you valued a company using conservative estimates of cash flows? What does that mean? You're taking your expected cash flows, you're not going to use them, you're going to go with a lower number. Why? Because you're trying to, in a sense, adjust for risk in your cash flows. The danger of doing this is you're now going to be double counting risk, right? Because you're lowering the cash flows more for companies you feel more uncertain about. And you're discounting them at a risk-adjusted discount rate. So be careful about how you adjust for risk. If you want to adjust in the discount rate, adjust in the discount rate. If you want to bring it into the cash flows, but don't try to bring it in both places because you create complete messes. So let's very quickly hit the probabilistic approaches to see why you might pick one over the other. As I said, it's now become much easier to ask what-if questions about key inputs. You saw this with my Excel spreadsheet. You can do scenario analysis, you can do simulations. Let's start with what-if questions. I teach a corporate finance class where people ask what-if questions on projects. On valuation class, they ask, let's be very clear. When you ask a what-if question, then you're changing one variable, holding everything else constant. As I said, that can get us into trouble. And don't lose sight of the end game. The end game in what-if analysis is not to churn out more and more and more what-if numbers and end up with a range that becomes completely useless. Have you ever seen banking ranges for value? The stock could be worth anywhere from 5 to 120, and there'll be a bunch of what-ifs to back that up. But you know what? I get to buy at a price. I don't get to buy at a range. So what's the point of giving me a range that's so wide it's useless? And less is more. If you're going to ask what-if questions, don't ask it about 20 variables. Pick the 1 or 2 or 3 variables that you think are key. And as you can see, that'll vary depending on whether you're valuing a young company or an older company. So the limits of what-if questions, one is one variable. The other is the correlations, as I pointed out, across the variables. When you change margins, often other things are changing in the background. And keep those. So I'm not saying don't ask what-if questions, but be careful about what you do with them. So, on September 23rd, 2022, I valued the entire index. I'm not a market timer, but this year there's been a lot of demand. So what's the value of the index? So I've done an intrinsic values. If you want, you can go back and read my entire blog post on what my estimates were. But I'll cut to the chase. I ended up valuing the index around 3,500 to 3,600 was my intrinsic value for the index. It was trading at about 3,600 plus when I did it. And I said, you know what? I know there are a lot of stories going around about how the market is massively oversold or massively overbought. I have no idea where these stories are coming from. I'm sick and tired of people telling me stories. This is what I see. And then I said, you know what? I could be wrong about every input. And this was a valuation of the index where the key inputs were, first, what's going to happen to earnings in the near term for the entire S&P 500? And let's face it, the big question here is, will there be a recession? How severe will it be? And it's going to show up as an earnings effect. So I looked at 3 scenarios: earnings 30% below analyst estimates, 15% below estimates, or they come in at estimates. The risk-free rate, big question, right? Where will the T-bond rate end up after all is said and done? Maybe it'll end up at 4, maybe it'll end up at 6, maybe it'll end up at 2. And the third big question is, how will this all play out in terms of how people see risk? Will we revert back to where we were before the crisis, around 4%? Or we're going to end up around where we were after the 2008 crisis, which is 6%. So this is a what if, where I'm basically varying 3 variables. And I find this kind of what if to be more useful, because rather than saying, what's the break-even growth rate or the break-even margin, the question I'm asking is, what's the break-even combination that I need? You're saying, how the heck do I read this graph? To read this break-even graph, you got to tell me what your story is for interest rates, the economy, and earnings growth. If you go with the consensus story, guess what? The market's fairly valued. That should come as no surprise. Consensus stories usually deliver the market value. In fact, I've outlined 4 scenarios here that could potentially capture, I think, almost every potential sub-scenario. The first is there's a group of people out there, much smaller group than used to be, that think this whole inflation thing is much ado about nothing. So we're going to borrow from Shakespeare and say, this is all, tempest in a teapot. Inflation is really only 1%. This is supply chain, COVID, it'll all pass. The Fed is overreacting, the fiscal people are overreacting, the market's overreacting. And if you truly believe that, you should be buying stocks like they're going out of crazy. Buy anything. The S&P 500 is massively undervalued because rates are going to come down, risk premiums are going to revert back to where they used to be. I'm getting a value of 54.49 for the S&P 500. The second is that Jerome Powell is the second coming of Paul Volcker. I started in the market in 1981. I remember the Volcker years. I remember what had to be done to break inflations back then. And what had to be done was you had to go into really severe, it wasn't just a recession, it was a really severe, long-standing recession. What's that going to mean? You're going to see equity risk premiums. First, you're going to see earnings drop fairly dramatically. I'm using 30% below estimates, which means that there are very few ways you get back to where we are. You'd have to have risk premiums drop at the same time, but you can see that under a Volcker scenario, it's going to be much, much more difficult to get to where we are in the market. There's a third scenario, which is even more damaging than the Volcker scenario. I'm going to call this the 70s show. Next time you hear the word pivot, I want you to think the 70s show. You know what happened in the 70s? Inflation showed up. The Fed said it was going to act. It was very decisive. They said, we're going to raise rates and we're going to break the back of inflation. About 3 months or 6 months later, too many complaints would come in. Politicians would start to scream. The inflation rate would go down a little bit. And the Fed would say, you know what, maybe we overdid it. They took their foot off the pedal. So all through the 70s, this is what the Fed did. So what ends up happening, you end up with the worst of all combinations, which is you end up with inflation staying high and interest rates staying high, but the economy never quite takes off. It gets stuck in this. So you get a combination of high inflation and a bad economy. The 70s show. Now, I really think all this talk of a pivot is extremely unhealthy. Because markets go up and, maybe Fed is going to pivot, maybe it's not. If I were the Fed, I would say, I'm going to send the Federal Open Market Committee home for the next 3 years. We're going to put rates on an autopilot. This is going to go up 0.75% no matter what, at least for the next year. And we'll come back a year from now. There's going to be no reversal of this because this talk of a reversal could actually be much more damaging for markets because you don't settle into any degree of consensus. And there's a final scenario, which is what I call the live and let die scenario, or live and let live scenario, which is, what's the big deal about inflation? We learned to live with 5% inflation. Let's go there. I don't know which of these scenarios will unfold, but when I look at the break-even table, I'm looking at the story you would need for a number, because otherwise it's just a collection of numbers in a table, right? There's a story with each of these numbers that you're looking at. So when you do what if questions, maybe it's better to pick a couple of variables and do break-even tables rather than one variable and solve for it, because it'll give you a much richer assessment of the company. So any questions on sensitivity analysis? What are questions? Let's talk about scenario analysis. Scenario analysis is most useful when you have 3 or 4 possible scenarios that can unfold, usually driven by something, an election, a regulatory change. For instance, I used this when Boeing, when I was looking at a new jet was creating, but I used it in 2009 when I was valuing a company called EasyJet. You guys familiar with EasyJet? It's a UK-based discount airline that gets the bulk of its revenues flying people in from Britain, usually during winter, to Spain and Greece to get away from the cold, to get some sunshine. The reason I'm setting that up. It's a discount airline, UK-based. This was a valuation in March of 2019, when you had peak Brexit uncertainty. Peak Brexit uncertainty. We had no idea how Brexit would unfold. Now, why would that make a difference? As an airline that was flying to Europe, EasyJet was particularly exposed to how Brexit would involve, because whether it could continue to fly the routes that it could was very much a function of whether you were going to have a hard Brexit, which was still a possibility then. Hard Brexit would have meant that the European aviation authorities could have shut EasyJet off from flying into Europe, completely destroyed its business, all the way to soft Brexit. I actually valued them on the assumption that there would be Brexit, but wouldn't be a hard Brexit. The value that I got was about 19.38. The stock was trading at about 22.57. But to me, the big uncertainty here was what will happen in terms of Brexit. So rather than try to bring them all into one valuation, I did 3 valuations of the company. One was what I call no deal. Now, at that time, the EU and the UK were still negotiating, no deal. Think of that as hard Brexit. The UK leaves with no deal. No deal would be catastrophic for EasyJet. You can see the value per share drops to 12.02. The second is there's a deal, but it's delayed and messy. The value that you get is 15.70. The third is you get soft or no Brexit, 19.38. 3 scenarios, 3 very different outcomes, 3 values. But to complete this, you have to attach problem. If you do scenario analysis, go the distance. Don't just do scenarios. There are 15 scenarios. My value is different under each scenario. That's nice, but tell me which scenarios are the most likely ones, which are the least likely ones. Attach some probabilities. In this case, I attached 25% probability to no deal, 50% for delayed, and 25, and I got an expected value across the 3 scenarios. This is a tool that's most useful when the what if you have is about an event. But right now, let's say you're valuing a Brazilian company, Petrobras. That's a big uncertainty hanging over your head that's going to be resolved in about 2 weeks. The Brazilian elections are going to happen, right? You could argue that the value that you get for a Petrobras will be very different under a Lula presidency than in a Bolsonaro presidency. But rather than try to bring them all, how the hell do you bring them into one DCF, right? It's almost impossible to do. You might actually have to value them twice. In fact, in emerging markets where political connections can sometimes be your biggest competitive advantage, the value that you attach to a company can be very different depending on who wins an election. That has historically not been true in the US. But we're getting dangerously close. And this is what terrifies me about about how we're evolving, is we're getting terrifyingly close to what the value of your company could be a function of who wins the next election. But in emerging markets, this is more the rule than the exception with family group companies. The best way to deal with it is to bring it through scenarios. And in fact, when I valued Zomato, the way I played out scenarios, I said, look, I have a story for Zomato, but your story can be different. This is the nice thing about storytelling valuation, is you can take a bunch of different stories, make each story a scenario, and say, these are the stories. And then I've broken the scenarios because this is what I need to do. If you're asking me for advice, and say, look, there are a bunch of scenarios. Some are only plausible. I wouldn't go there. Some are probable. And so basically, you need to separate out the plausible from the probable. And sometimes you might get a fairy tale scenario. So that's not going to, there's no chance of that happening. But framing your scenarios around stories can make them richer. People will remember them more than scenario 1, scenario 2, scenario 3. What the heck do you get out of scenario 1 through 9, right? Each scenario is telling a different story about the company. Flesh out what each scenario means. And as for decision trees, I won't bore you, but this is what a traditional decision tree looks like. If you've forgotten decision trees, You see those little triangles? That's basically an end node where you get an outcome. The squares are, choices you can make. So you can either test or not test. The circles are probability nodes where God decides what's going to happen, or some acts of fate decide what's going to happen. So this is actually a decision tree for a diabetes drug. So I'm trying to value a company producing this drug, and you can see that you can test for the drug. The test can go well, test can go badly. If it succeeds, you produce the drug. The drug has to go through 3 stages of the approval process. And if it all succeeds, you can come up with cash flows and value. But to get there, you got to go through all of these sequential steps, and I've attached probabilities to each step. If you work out the values at the end nodes, the value of this drug can range from, basically if it fail at the last stage to be an incredibly successful drug. You basically can end up with very different values at each stage. But if you have a full decision tree, what you do is, it's called folding back the tree. Use the probabilities to get expected values going back. And I can tell you what the value of this drug should be today. It's 50.36 million. Based on all of the possible outcomes. And look at the range of outcomes. It can be from minus 329 million to 887 million. I've folded back the tree to come up with an expected value. You can already see it's a lot of work, right? It's work that requires that you break risk down into stages, attach probabilities to each stage. So most of the time, it's tough to apply it because you don't have the data to make these. You know why it works so well at pharmaceutical companies? Do pharmaceutical companies have a history of having drugs go through stage 1? Yeah, so you can actually assess these probabilities based on looking at past data. Stage 1 approvals, only 35% of these kinds of drugs make it through. Stage 2, you're at 60%. Stage 3, you're at 90%. Doesn't mean you can't be wrong, but you have the data to do it. So decision trees are useful if you have information on sequential risk and the risk is in fact sequential. And of course, the last way of dealing with, and this is my preferred way of doing with it because it's the richest of the risk of what if ways. Rather than pick one variable like you do in what ifs, or doing a break-even table, or doing scenarios, in a simulation, you're essentially running millions of scenarios. You're allowing for all kinds of outcomes. Putting distributions, and as I said, the big trick in simulations is coming up with those distributions for revenue growth, for margins. It's work, right? Because to come up with those distributions, you got to look at data, either historical data. So if you want to do distributions for inflation or interest rates, you can look at historical data, inflation and interest rates. If you're going to do distributions for operating margins, you might use cross-sectional data. So if you're looking at software companies, you can look at margins across software companies. But the key in simulations is being able to have enough data to be able to do that, enough statistical knowledge to come up with the right distributions to use, or at least there. So that's basically what you do in a simulation. I'm going to close with a valuation where I did a simulation. Remember I said that there are some companies where it's a macro input more than any other that's driving evaluation. I'm going to be secretive. If you ask me to value a Ramco, or better still, a Royal Dutch or an Exxon Mobil, it's a one variable that I'm uncertain about that's driving value. It's not about, margins or costs. It's really about the oil price, right? This is a valuation where the entire uncertainty is captured in one variable. Just to show you, back this up. If you take Royal Dutch and you graph out their revenues over time, and this is from 1989 through 2015, and you graph out the average oil price, this is a brown line each year. Ask your question, do you think the two move together? You don't need a statistics analysis to see that the two move almost in lockstep. In fact, if you don't believe me, you know what the R squared is? 96%. So if I'm valuing Royal Dutch, if you ask me who the CEO of Royal Dutch is, you know what my answer is going to be? I don't know, and I don't care. What the heck is he going to do anyway? Come watch the oil price terminal a little more carefully? This is an oil price play. And in fact, using these years of data, I ran a regression. And this is where statistics can help us a little bit of what the revenues at Royal Dutch look like as a function of the oil price. You're saying, what the heck does that tell me? Every $1 increase in the oil price pushes up revenues at Royal Dutch by $4 billion. So what I did was I did a base case valuation of Royal Dutch. This was in 2015. Oil prices had dropped to about $40 a barrel. I did a base case. You're saying, what does that mean? I computed what the revenues would have been at a $40 oil price because the oil price had dropped from 65 to 40 in the previous year. You know, usually we use last 12 months data. Don't do that for commodity companies because your last 12 months of data would reflect the average price over those 12 months. If the average price has gone from 65 to 40, you're already setting yourself to overvalue a company if you use last 12-month data. So the nice thing about doing the homework on what does the revenue as a function of the oil price is now I can restate revenue to reflect the current oil price. I call this an oil price neutral valuation where I'm valuing the company, Royal Dutch, at the existing oil price. I valued them at about $39 per share. Stock was trading at 42. I actually did this for a Royal Dutch finance group. And one of the people in the group said, well, what if oil prices change? And I said, what if they do? He said, what if they go up? And I said, your value will go up. And what if they go down? Value will go down. So we could do this for as long as until the cows come home. But what do we learn by doing that? He said, but I'm uncertain about the oil prices. So is everybody else in the world. So what can I do about it? I made a suggestion. I don't think he took it. I said, oil prices, I have a distribution. I didn't even have to do my homework. It's a traded commodity. I have a distribution. What if I, instead of using the $40 oil price, I put in a distribution centered around $40, but allowed for the fact that it can change. And then I ran a simulation where the only variable that I was simulating was the oil price. So I'd go in and pluck an oil price out of the distribution. Let's say the first draw, I get $53. I put the $53. Remember, I had my way of estimating revenues based on the oil price. I put the oil price in, I get the expected revenues. I value the company, I get $51 per share. Then I do this again and again. And each time I do a draw, I get a different value. What I get as an output is a distribution of value for Royal Dutch across oil prices. My median value is about 37, very close to what I got in my base case. And that shouldn't surprise you. The reason you do simulations is not get a different expected value. It should be pretty close, right? You're building off the same base assumptions. But what you get is a distribution that you can use in your decision process. For instance, instead of using a margin of safety, what if you said, I will buy a company only if it drops to the 25th percentile of value? And you can see that drop has to be very different for companies we feel very uncertain from companies we feel certain. Because it's not about drop in the price relative value, it's a drop in your intrinsic value that you need to get to the price. It's almost a flexible margin of safety, where your margin of safety shifts depending upon how uncertain you feel about the underlying variables. It's a richer version of Seth Klarman's margin of safety, where rather than sitting with a 40% margin of safety apply across all companies, you finesse it based on how uncertain you're about value. So here's my advice on uncertainty. Don't hide from it. It's not going away. It's part of life. Face up to it. We have tools. Use your tools, right? Start with the break even, the what ifs, the goal seek to get a sense. But that's for one variable. That might give you a sense of what's the market assuming, but to get a richer sense of this, convert it into 2 or maybe 3 variables. Don't go carried away and have 15 variables and have break-even tables. And then attach stories to different cells in the table, right? Because, what does a high revenue growth and a high margin mean for Tesla? I must be assuming that this company can then get beyond the automobile business into the energy business and making margins on software. Start thinking about the stories that go with each cell. Doesn't mean your base case valuation will change, but it'll give you a richer sense of what the what ifs mean. And if you can convert point at inputs into distributions. We have the tools now to be able to do that within Excel. I use Crystal Ball, which is an add-on to Excel to convert, my DCFs into simulations. It's an Oracle product. You can get a trial version, I think, by going to the Oracle website. But there's an at-risk, which is another add-on to Excel. But the advantage is you can take a base DCF you've already done and make it into simulation almost effortlessly by adding those tools. But I think that the mistake we make is we close our eyes to uncertainty. We act like closing our eyes is going to make it go away, but it isn't. It's always going to be there. So the choice we face is, do you want to look it in the face and make your best judgment, or act like it's not there and hope it doesn't hurt you? And the latter seems a much more dangerous way of investing than the former. So find your own coping mechanism for uncertainty. It's as much about you being comfortable enough with your valuation. Remember, this is about acting on your valuation. What uncertainty does, it keeps you from acting. So I'm too uncertain, I can't act now. It's and if you want to be able to act on your valuations, you need to be able to get over that fear of uncertainty. And these tools can help you do that. Any final questions?
Professor, that was amazing. So just to review, back in November, early November, you valued Tesla for us. You had revenue.
November 2021.
Yeah, 2021, sorry. Revenue going to over 400 billion in 10 years. You had operating margins expanding at the time, 400 basis points. You had
From
Tesla
16 to about 20% still,
Yep,
right? I was still targeting 20, but they were at 16 then, moving to 20.
So 400 basis points. You had return on marginal capital of 50%, and you're using a 6% discount rate.
Yeah.
You got a value of around 350 split adjusted. Today,
No,
the
I
stock.
got a value around 190 split adjusted, right? My value was
I'm sorry, the
570
stock
per
was
share.
at, I'm sorry, the stock was
Stock
at
was at
350. I'm
350.
sorry.
I got a value of 190.
Exactly. It's at, your new value is 177. I think the question in all of our minds, are you going to buy at 177, or do you require a margin of safety from there?
I would probably buy at 177. I'll tell you why. There is an optionality in companies. You know what the optionality is, which is,
yes, sir.
There are things that can happen. There are clearly uncertainties, but there are uncertainties here that I've not built into my DCF that will work in my favor. It's the reason I would buy social media company when it gets fairly valued, because if you have that platform and somebody can figure out what to do with that platform, and I'm not talking Twitter and Elon Musk, obviously, but I'm talking about, Snap and, people saying, look, I can buy that platform. There is that upside. So it's almost like, there's uncertainty, but the uncertainty is more upside, which is the options argument. So with some companies, there is an argument, especially with young growth companies, that you should actually buy it with a smaller margin of safety. It cuts against the intuitive argument, right? Which is, I would need a bigger margin of safety with Snap than I would with Coca-Cola. I would argue differently. Snap, there's not much to lose. There's not much existing assets you've already built in. And if there's an upside, it's going to be far more so there's an optionality here, which I think makes these companies attractive whenever the value gets pretty close to the price. But you got to do it with the open eyes that it's the optionality that's driving you to invest in the company. It might not show up for 2 years. You need a long time horizon for the optionality to kick in. But I would buy it at if it got close to 175 or 177.
Do you still consider your Tesla assumptions as pretty bullish?
If you step away from the year-to-year issues, right now, I think the biggest issue with Tesla is it's a personality-driven company. And the personality that's driving it seems a little distracted right now. That is, I think, my biggest fear, if I were a Tesla investor, is how do you first get the separation from personality? Because if you're paying $600 billion, $800 billion, $1 trillion for a company, you're not buying it for the next 5 years. You're buying it in perpetuity. And let's face it, even the greatest person on the face of the earth is not going to live forever. You need to build a company that outlasts you. So the first is, how do you get that separation of personality? The second is, can the distractions actually get in the way of what Tesla needs to get done? Because it still has a big task in front of it, right? To become the largest automobile company in the world. Will any of these distractions get in the way? So right now, the worry that you have for Tesla is that these distractions might get in the way of their story. Now, So as an investor, I'm watching the other stories about Elon Musk as much as I'm watching Tesla in terms of whether it's going to get in the way of my story. Right now, I'm not assuming too much of a feedback effect, but I stand ready to be corrected if that's not true. So I think right now the issues you have with Tesla, it's actually delivered some. I mean, it's, as I said, it's surprised me in terms of the margins it's been able to deliver. And if you don't measure its revenue growth against some made up number in your head, it's moving at levels that you did not expect it to move. We went back and looked 3 or 4 years ago. It's getting to the point where it's close to $100 billion company. There was a time when I was told it would never be a $100 billion company. My first valuations of Tesla, it would never be a $100 billion company in terms of revenues. That's clearly going to be something they can blow through pretty quickly. Another question is, can they get through the 200? And is it going to get more difficult? Yes, I think because they face more competition, not just from the existing automobile companies. I think that they can fend off, but from the Neos and the, Nikola's, Nikola might be a bad example, but
Rivian.
the new startup electric car companies in the world. I think that's going to be the challenge. And I would be most worried about electric car companies that are Asia-based, that come in with a lower cost structure, that might be going after the mass market.
$2 trillion auto market. Is that about right?
That was what it was last year. But again, there's a wild card here, right? Which is this other story of automated driving working its way through.
Yep.
And if that story is right, the steady state for revenues in the auto market might become much smaller. Why? Because we don't need as many cars. I mean, remember, most cars, where do they sit all day? They sit in the parking lot. Mm-hmm. Why? Because after you've driven them to work, they can't drive themselves home. So you could argue that once you have, so there are all these stories that people tell as if they were separate stories, and they use them to justify different investments. And then it'd be interesting to take Kathy Wood's big stories for whatever 12 companies you own, put them all together and say, can you see a world where all these stories actually hold at the same time? So the reason you're buying Tesla is because you think automated driving is going to be the future and Tesla is ahead of the rest of the game, then shouldn't that also mean that the total market for automobiles is a much smaller market and that Tesla's revenue? I mean, so it's almost like there are these stories kind of swimming on top of each other, and you got to figure out consistency across your macro stories. Yeah, as well.
Because that 420 billion in revenue on 2 trillion.
That'd be about a 20% market share.
Yep.
If you adjust for inflation, it's probably less. And I know there'll be people who are bullish on Tesla who say, no, 20% is too small. But if you look at the history of the automobile market, 20% is a pretty awesome market share to have. And that's what they peaked at, right? The Toyotas and the Volkswagens. So unless the economics of the electric car market have some weird networking benefits, and maybe the charging might be, I see that's a component that maybe can open you up to a bigger story where they have a much bigger market share. It's difficult for me to see a revenue story of $1 trillion or 2 trillion or 2.5 trillion or whatever you might need to justify what they were trading at their peak about a year and a half ago. Is, what is it, $1,500 per share, $1,600 per share? And at that point, you got to ask, what would the revenues need to be? And then you can ask, is that even feasible? That might be a good what if, is what would the end revenues have to be for you to get to the price today? And then is the market even big enough to justify those end revenues?
Professor, this was another 2 hours of your time. We cannot thank you enough. The last class in November, 2 hours. This class, 2 hours. Honestly, thank you so much, Professor. You're the best, and we are grateful for your time.
Take care.
Bye-bye.
Good luck. Bye-bye.